So in today's Cardinal lesson, we're going to teach you the difference between tax-free and tax deferred. And they're two very different things. And there's some products, some ways people invest that creates a benefit of a tax deferral. One of those is a traditional IRA. There's very few products or places you can invest money where it's totally tax-free, and one of those is a Roth IRA. And in order to get the benefits of a Roth IRA, you got to pay the taxes up front. And that's a hard pill to swallow for a number of people. And so we're going to talk to you about compounding today and teach you some simple rules. And with that, I want to go to Tom, and I want Tom to tell you really why we're doing this business today of tax deferred and tax free.
Yeah, we really want to just show you sort of the benefits of tax-free compounding growth. The compound interest, the compound growth, we'll go over that on the board. But really, the Hans and I were talking before the video, any given year, if you look at that one specific year, Roth accounts never make sense in that year because you could have saved taxes in that year by putting it in the traditional. So the real benefit is over time. And we want you thinking about, yourself 20 years from now, 15 years from now, whatever that time frame is, what that self is going to like. And the tax-free accounts are going to be wonderful compared to the traditional IRA. So we're not opposed to either one really, but I think too many people look at the tax benefits in any given year and make decisions based off that, and they miss the picture long term. So let me bring up the show notes real quick. These are found at the link below our video. They're also on our website. We don't have a ton of stuff in today's shows. We got the board, and then this is just pulled directly from the IRA. So let me just read you a couple points where they talk about what is a Roth IRA. And it's interesting. They say a Roth IRA is an IRA except as explained below. So essentially, it acts just like a traditional IRA, except for these different things. One of the big ones, the second one, if you satisfy the requirements, qualified distributions are tax-free. That tax-free is important. And then the top one, obviously, is also important. You cannot deduct contributions to a Roth IRA. So you don't get any tax deductions the year you make the contribution, but when they come out, that plus the growth is tax-free. That's really, if I just summed it up, those are the two differences between the accounts.
Yeah, so till I started practicing with Tom several years ago, I didn't realize how much calculating I do in my head, how much math I do in my head while I'm talking to people, while I'm looking at their assets. I'm thinking of things they can move into and out of. I'm looking at their stuff historically. I just didn't realize how much math I did in my head because Tom's over there. He's getting the accurate answers and the accurate projections because he's working on the computer. I'm doing the talking, and if I go to the computer, I lose my train of thought.
I will jump in here real quick and say Hans is pretty accurate in his head. I'm impressed. And so he's doing this stuff real time, and I'm double checking him. He's like, "Is you sure that's right?" And almost all the time, he's pretty close. So I'm impressed there.
Well, I wrote this whole show, did not use a calculator, didn't even think about using a calculator. So I'm going to teach you the rule of 72 today. And if you haven't heard that, this is a chance for you to learn something. If you have, and I checked with Tom, Tom knows of the rule of 72. I don't think he uses it that much, but I use it every day as I'm looking at people's stuff. I'm doing financial planning for them. I'm thinking about what I'm going to move them into. And what the rule of 72 does is how many years at a given interest rate does it take you to double your money? And then double it, quadruple it, and so on and so forth. And the rule of 72 says if you take the interest rate and you divide it into 72, the answer will give you the number of years it takes you to double your money. And you can try me on this. You can take any interest rate, if it's over a year, and work it against it. So I've run this at 6% interest, and I'm thinking that most of our clients, they come into us wanting 8 to 10%. And of course, we can't promise that to anybody. We can't promise any interest rate, but we can manage a portfolio, manage risk to attain an interest rate as a target. And so people come in and kind of how much money can you make us? And they're thinking larger numbers than I've got on the board here. And generally, we're trying to get people to lower their risk factor, at least on the whole of their money, when they're in their 60s and approaching retirement, simply because a severe market correction or something could just send them into a bad place right after they retire. So I use 6% as like a reasonable conservative growth rate that I'm going to use. And if you're able to obtain 6% interest or 6% gain on your money, it takes 12 years to double it. 6 into 72, 12 years. Then I also ran it at 8%. So if you divide 8% into 72, it takes you 9 years to double your money. So, and that makes a big difference over time. And so why am I going through this? Is I'm trying to show you the power of compound interest. And I think in those terms, if somebody has 20 years or 24 years till retirement, and they got 100 grand in their account now, well, we can turn that 100 grand into 400 grand in 24 years at 6%. Okay. If they've got 100 grand, we can turn that into 400 grand at 8% in 9 years. So just a simple calculation that's going on in my head, and you'll see where it applies to our examples here. So the neat thing about either kind of Roth, this one's tax deferred, meaning that you don't pay taxes now, the traditional, but you're going to pay them later. Tax deferred means not tax now, but tax later. This one means tax-free now, tax-free forever, tax exempt. It's never taxed. Even when you die and pass it on to your kids, they got to pull it out in a certain number of years, but it's tax free to them. So you have an account that you can leave with your kids. So you can leave to your kids and they're not going to have a tax problem. You can leave it to your spouse, or you can prepare for yourself in a retirement in your 70s and 80s where you've got this big bucket of money that's tax free. And for me personally, you can show me all the calculations you want. I've done a lot of Roth conversions that are been painful to pay those taxes now at a younger age. But now I've got a few buckets of money that'll be available to me after I'm just gone and my wife lives on. It'll be available to her. And then, we may never touch that money. That's kind of our deepest savings that's there. We may touch part of it. It just depends on our tax situation. But ultimately, that's going to go to our kids, and they're going to have that money unencumbered with taxes. So the feeling that's generated from that and the security is sweet. So what I want to get on is I want to impress upon you, especially people in their 50s and 60s that are making a good income, they're still working, they got a pretty good size 401k balance, they're thinking of increasing their contributions, maybe they've already done, but they're over here. Most people that we see coming in have very little Roth money, or they just have a little bit that they've done in IRAs out to the side, but their 401k, where maybe the bulk of their money is all traditional. And the first thing we do with those people is, does your employer offer a Roth 401k option? And in many cases, they go back and check, or they already know it's there. And so what I've created is an example of a 50-year-old person that participates in a 401k, has a good income, they can afford to do this. With their contributions, they're going to stick 20 grand into the traditional. That's what they're doing right now for this 1 year in 2024. And so we're showing you two ways. One way is they put it in the traditional, like they've been doing. The other way is they put it into the Roth. Now understand, if you're going to put 20 grand in your Roth, you got to make like 28 or 30 grand to pay the taxes to have 20 left over to put into the Roth. So this can be painful. And if you're over here in the traditional, this is what too often people are focused on. You're still putting 20 grand in, but only 12 grand of that is your money. Because if you didn't put it in here, you'd be paying 8 grand of taxes that you're postponing. You're putting into tax deferred. So you got 20 grand in there, but 8 grand of it really came from the IRS. And they said, we're going to get our money later. And so I just want to show you from the rule of 72, the compounding. This is 50-year-old at 6%. That 1 year's money is going to grow to 40 grand at age 62. It's going to grow to 80 grand at 74, and it's going to be 160 grand at age 86. There are no minimum distributions on Roth. So that can be the core money if you have both kinds. You don't have to take it, but you can take it. And when you do take it, there's not taxes. Over here, same 20 grand that went in, been no taxes all along. So the money's still there, but it's like you got a mortgage on the money. So I want to bring Tom on, and Tom wants to just add a few things about this.
Yeah, I mean, I think the all too often people look at sort of the year you're in. I want to pay less taxes this year because that always sounds nice. Is I don't want to pay as much taxes as I want to pay as little as I can. And so they do this. They put it in the traditional. They see the tax savings, or they, in other words, how it really happens is they do it out of each paycheck. Their paycheck doesn't go down by as much as the money going into the 401k. And so it's nice, right? I still get a check. I'm putting money aside. It feels everyone's happy, and then they get to retirement and they start looking at these accounts, and oftentimes they're much higher balances than we have on the board, right? They might be in the millions of dollars of money, and now they're looking at this whole thing, and they sort of have this realization, and then we can see this happen in client meetings we have. It's like, oh man, I've done this my whole working career. Now I have to take it out. Now I have to pay taxes on. Now my Social Security I'm gonna have to pay taxes on. Now I might have to worry about IRMA, extra costs for Medicare. And they sort of have this sort of panic moment of like, what do we do? I mean, we have this balance, but it's not all your money. I think people often miss that as they look at their balance in their 401k, their IRA. I'm talking about traditional right now, and they see it as their money, and it's not. Part of that is the IRS has a lien on that account, and so if we assume like a 25% tax rate, meaning when you pull money out, you got to pay some federal, some state, that $160,000 is really only worth about 120 to you after we account for taxes. And then the 320 is closer to like 240 what it's worth to you. And so, that money isn't all your money. Whereas on the Roth side, all of it is your money, right? You have 160,000 in a Roth account, that's all yours. That's all your spouses. If you're married, that's all your kids when they get it. There's just no income tax. You have to worry about that. But to get there, you have to pay the taxes now. I think we're in such a time, also from a tax rate standpoint, where taxes are so low, historically low, is that it makes a lot of sense to put it there. And then we know tax rates are in the current law. Tax rates are going to go up in 2026, and who knows what they're going to be 30 years from now, right? I mean, I'm saving for 30 years from now when I retire. All my savings is going into Roth. I want that years of compounding growth, of tax-free growth, and then I don't have to worry about what future tax rates are. And so it's just a real benefit. It's painful now. That's also related to Roth conversions. Roth conversions are not fun to do, right? I go through this all the time. We run the numbers. We pick a number. I recommend you convert $100,000 this year. They say, okay, how much tax do I have to pay on that? Well, between federal and state, you got to pay 30,000 in taxes. They say, excuse me, how much do I have to pay? It's like, well, 30,000. And then they say, I'm not doing that. I mean, it's really painful to do that in that moment. The benefit is long term, but it can be very beneficial to consider doing that.
So here is the benefit of compounding. Let's look at it a different way. We got this person at age 50. They're sitting here. This guy, this lady is expecting to make 6% on their investments. This one down here is expecting to make 8%. So for an $8,000 investment on behalf of the IRS and the state tax people, that's an investment. They're giving you 8 grand. It looks like it's your money, but it's really their money because it's the taxes on your earnings. So you're letting them into the game here where they make an $8,000 investment, and then whatever the tax rate is down here on their $8,000 investment, they're getting back 50, 60 grand. I mean, it's just because of the effect of no tax on the compounding as opposed to deferred tax. So if I get a little less objective and more subjective, and I just look at myself, it's painful to do these Roth conversions, but I've got them set up. I'm still contributing to the Roth of my 401k here at Cardinal. And, I've set up so that I have a progressively larger pool of money that's available to me tax free in retirement to create an income. There won't be there won't be much tax on my Social Security because it's going to not be driven by taxable other income. And, that's comforting to me. It's comforting to me to know that if I die before my wife does and she lives on when she's a widow and she has this pot of money that she can draw on tax free, and she probably won't. I mean, I just know her. And then to know that it'll pass on to our two sons and they're not going to have to pay any tax on it either. It's just hard to put a price on that. I mean, subjectively, that's extremely valuable to me, and it'll get more valuable as I age. So I want to bring Tom back on, and we just want to talk about, within terms of holistic planning, what we've touched on today: Social Security, the IRA, 401k. We talked about income and having a tax-free income or partially tax-free income. We've talked about passing on things through our estate, IRA money where it's tax-free to the kids. And then obviously the whole show has been about reducing taxes, whether they're tax deferred or tax-free. So I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening.
Thank you.